Welcome to the workshop sponsored by HashKey Group. Today we're talking about getting started investing in digital assets. My name is Walter Jennings and I lead corporate communications at HashKey Group. Joining me today are my colleagues Gerry Ifill and Nejteh Demirian. Gerry is head of trading and brokerage at HashKey Group. He has more than 15 years of experience in financial services. Before joining HashKey Group, he was with UBS, where he served as managing director, responsible for institutional sales of fixed income currencies and commodities. Also joining us, Nej is HashKey's senior product management and structuring director. Prior to HashKey, he was portfolio manager and founding member of the Hong Kong family office Fountainhead Partners, managing multi-asset portfolios across various asset classes. Now, I'm going to kick this off, Gerry, with a question around the state of play of the digital asset industry. The last year, we've seen tremendous growth in interest and adoption in digital assets. What are some of the key factors driving this growth?
I think there are a lot of factors, Walter. I think, firstly, macro factors. These are factors and effects that are having an impact on all financial markets, both traditional and digital assets. And that is to say, with COVID and the response from most Western governments in terms of printing money and stimulating economies, we have a very significant increase in money supply. I mentioned earlier to you that the Fed balance sheet is at multiple times higher than it was even during the financial crisis in 2008, 2009. So this additional supply of fiat currencies, with obviously a limited supply of Bitcoin and other digital assets, creates an opportunity. So I think there are a lot of nascent investors in digital assets, in crypto, who are not really terribly focused on the macro environment at all. But I think for institutional investors who have come late to the game, as it were, this is a big driver, and I think a big determinant of the upside that still exists in digital assets, because institutional investors to a large extent are looking for alternatives to fiat currencies and have not yet jumped on the bandwagon, so to speak, in terms of adoption of crypto assets. So I think that's where a lot of that upside comes from, and we're only beginning to see that transition take place.
So we've seen strong uptake amongst the retail market, but Nej, when we look at the professional investors and institutional investors, what are some of their current attitudes and appetite like for digital currencies?
Well, currently, I believe that a lot of them are looking at crypto as an optionality into an asset class that's growing, right? And that, in part, that is reflected a lot in some of the US endowments that have already started to take positions in crypto in order to get that exposure. Now, the next stage is actually, the other larger institutionals. You're looking at pension funds, sovereign wealth funds, and these guys are going to be approaching the asset class, with a bit more of a kind of timid approach, because they do have liabilities that they have to meet, right? But eventually, when the asset class does become a lot more mainstream, right, they will have to inevitably get involved.
What are some of the opportunities or advantages of holding digital assets?
Well, I think the main one is diversification, right? The ability to kind of be outside of the traditional finance market has significant advantages, right? Because we've seen the performance. People talk about how wonderful, equities or NASDAQ has been since COVID, doubling almost since the lows of March 2020. But in the same time, Bitcoin has gone from, 3,500 to 55,000, right? So there's a significant diversification benefit. And I think, personally, I also believe that there's an asymmetry in terms of volatility. The same sort of volatility and the same sort of concerns that drive outperformance in traditional assets do the same in digital assets, but we've seen multiple times more in terms of upside. So it's not just about having another element to your portfolio. It's about having another element to your portfolio that can, significantly positively impact the performance.
Nej, most institutional investors are used to investing in traditional assets such as equities, fixed income, commodities, currency. How is digital asset different as an asset class?
Well, it's first and foremost, it's extremely deflationary in what it offers. But this offers something that is fully fungible across geographies, across jurisdictions, right? It does it at a cost that's, multiples lower than what you see in the traditional asset classes. And it improves efficiencies as well. So what you see it offering is productivity enhancements in basically in transactions, right? And I think that's one of the key benefits that it provides them.
Okay. Gerry, you're head of expert at HashKey Group, and that really is the brokerage arm of the business. How do institutional investors get started in investing in digital assets?
I think the main thing is to have a venue where you can trade. So that is to either work with a broker such as ourselves, work with an exchange. Now we have a situation where there are several that are regulated, right? So across the globe. So, a regulated exchange with a custodial feature where you can feel that your assets are safe. A OTC broker such as ourselves, who also have a custody platform as well, where you can feel that your assets are safe. So those are those are the main things. You want to know that your assets are safe, and you want to know that you're able to transact in an efficient way without paying too much and without worrying about settlement risks and these sorts of things. So that is I think those are the two key things: liquidity through a platform, either a broker or an exchange, and also custody, so that once you've done your transactions, you can feel that your assets are not going anywhere.
Beyond Bitcoin, there have to be other digital assets that you can invest in. Can you introduce us to a few of those?
You have the alternative, which is Ethereum, which is almost as liquid, right? And then you have the Ethereum killers, and these are other layer one protocols that basically allow you to kind of get the same kind of function that Ethereum offers, which is building smart contracts and building decentralized apps around these. So these names like Solana, Polkadot, Cardano, these are the ones that are being developed now that offer solutions that are just as competitive as Ethereum. And you can get exposure to these with similar levels of well, not similar levels of liquidity, but close to, right? And these are very important for bigger players in the market that need that kind of size to get in.
Fantastic. Now, Gerry, there's been a proliferation of new investment products that investors can participate. Can you name a few and how people get access to them?
Firstly, I'd say they're not necessarily new. They're probably new to the digital asset world. And I think that's one of the reasons why our sort of history and experience in traditional assets becomes very useful in this environment. So we take some of the structures and products that we were very used to dealing with when the underlying was dollar yen or equities or index funds, and we take them into the digital asset space. So I think the real thing that we're trying to do is bring a lot of the same innovation that's taken place in traditional finance over the last 20, 25 years and immediately accelerate that innovation to all of the digital asset universe. And I think digital assets have led the way in terms of new concepts like staking and some of these, some of the other ways that you can earn with your balances. But we will also feel that there's an incredible opportunity to take, traditional derivatives such as options, futures, basis trading, and bring those all to crypto as well.
Now, Gerry mentioned the term staking. That's a fairly unique yield-generating mechanism. It's strictly in the world of digital asset investment. Can you explain staking and talk about how it generates passive income?
Well, staking is actually very, very simple, right? It just involves a process in which you lock up your coins for a particular period of time within a particular platform, and they just basically give you a yield on top of that for using that coin for a particular purpose. Now, the number of uses, it's just based on what that particular platform wants to do with those coins, right? But there is You can stake it for a day, you can stake it for a week. It just depends on how long you want to go for. But then you generate yield on top of that, which is either paid in terms of the coin or maybe some other coins as well. It doesn't necessarily have to be the same coin.
So you retain the ownership of the asset, and in one way you're kind of lending it while you still own the asset and its upside and downside, and now you're generating some income for that loan.
Sure. And what you get is you get a premium for your liquidity lockup, right? Because you're giving it up for a certain period of time. And during that period of time, you don't have the access to pull it and trade. Right? And that's what you get the premium for.
Okay, I want to dive a little deeper in staking. We've heard of traditional staking and DeFi staking. Can you break them apart and explain the difference?
Well, DeFi staking actually utilizes the decentralized exchanges. You take your coin and you put it into a contract that allows you to basically, on a decentralized exchange, provide liquidity for people to transact, right? That supposedly generates higher yields than traditional centralized staking services, right?
Now, along with staking, Gerry, what are some of the other common trading strategies unique in the digital asset space?
There are a lot of trading strategies that we employ. I wouldn't necessarily say they're unique to digital assets. They are part of the general framework of risk taking across any financial asset. So we do a lot of the same things that we did in the traditional space, which is to say we're looking for really high risk adjusted returns. So in digital asset space, we often see better opportunities than in traditional assets doing similar concepts. And I think a reason for that is the decentralized nature of digital assets. We have multiple exchanges, multiple platforms offering similar but not necessarily fungible assets. So that creates opportunity. And that is really, to a large extent, one of the main differences between digital asset markets versus traditional asset markets. The fact that there are so many different ways of doing similar things, and we haven't seen that sort of consolidation that happens. Everybody knows when they buy an Apple stock that it is an Apple stock. It doesn't really matter what platform they bought it on or where in the world they were. It's the same thing, and it's fungible. Obviously, in digital assets, when you do a futures contract on exchange X versus a futures contract on exchange Y, these may look the same, may feel the same, they may have 99% correlation, but they are not the same, and therefore differences in prices can be exploited. And that's really what we try to, or what I encourage everyone to look at and understand better within the digital asset space, because it's an opportunity that is very much germane to digital assets compared to traditional assets.
Now, despite the upside in digital assets, some institutions are hesitant to put funds directly into coins themselves, to own the coin. Are there options for investing in this asset class without owning the coin itself?
Well, yes, they are, right? They are, even within the traditional space, CME, CBOT, they have cash-settled futures, which give institutions, anyone with access to an E-Trade or interactive broker's account can trade futures on BTC and Ethereum. So that's one obvious avenue. But the other way to do it is through some of the ETF products that are coming out. There's not yet an ETF in the US, but there is one in Canada. I believe there's going to be one in Europe or Germany that has been approved. So these are also other opportunities. But I think what we are proposing, or what we intend to offer to clients, is to offer traditional style mutual fund or excess return products to investors where the underlying risk is in crypto or in digital assets, but the returns are much higher. So I think for investors who are willing to put dollars down and actually invest in crypto markets and some of the inefficiencies in crypto markets without actually taking direct exposure to BTC or Ethereum, this is something that's obviously going to be very attractive to them. And we're seeing more of these types of opportunities open up, and we plan to offer more of them in the future.
For institutional investors that are looking for a longer term investment in blockchain and crypto projects, other than due diligence and sourcing the projects themselves, what are their options for those longer term investments?
Their options are going into just longer term funds. There are funds available on the market right now, and there's more and more coming out now. And you can get into venture capital. You can get into early stage VC and coin funds. HashKey Capital does some of that as well. So there are a lot of options that are coming out, and it's going to be a bigger space now for institutional participants that traditionally they're used to getting fund exposure rather than underlying asset exposure, and that's how they want to kind of participate.
Gerry, when you're talking institutional and professional investors, they've got a different mindset and different requirements. How do professional firms like this engage with an exchange or a brokerage? I mean, they're obviously different than a retail.
Yes, they are, but I think the real key is to offer that additional level of security and so the official kind of status that an institution would need when it's doing its due diligence. I think if you think in the early stages of crypto, what stopped a lot of individuals, much less institutions, is kind of this concept that you're doing something so far off the beaten path, sending money to some bank in a country that you can't pronounce. Right? It's important as we sort of institutionalize this business to have kind of the same, features that institutions are used to dealing with. The same sort of official, banking and settlement and security. Right? As long as the crypto and digital asset industry can provide those things, it doesn't necessarily need to be the same as in traditional finance, but it has to have a similar level of safety, of officialness, right? And I think that is the key, right? Making sure that everything is done in a professional way, everything is verifiable, everything is subject to due diligence, passes all the tests, and then I think institutions, well, they already have done so, but will continue to embrace the opportunity.
Nej, when you're developing products, what are some of the unique benefits that digital assets bring versus other types of investments?
Right. Well, I think that one thing that Gerry highlighted earlier was the fact that there are you're trading things that are very similar to the traditional asset classes. The one key difference is that you're generating higher yields because there's the market arbitrage opportunities haven't totally been kind of diluted out yet by the number of participants. So it leaves a lot of opportunities on the table for the next 5 to 10 years for just to generate arbitrage returns that are generally higher than what you get on traditional markets. And this goes across the board. It's not just arbitrage, but yields in general are higher as well. In traditional asset classes, it takes a new type of credit product comes out. It might take a year or two until the market becomes comfortable with it and the yield starts to compress. Right now, what we're seeing in crypto is basically higher yields. And these higher yields will eventually compress, but during that period, there's still time for people to participate and generate generally higher yields that you get in traditional asset classes.
The arbitrage gives us opportunities, but there's also risk involved. How, Gerry, do you counsel institutional investors to think about risk when it comes to investing in digital assets?
A lot of people will look at digital assets and think, oh, there are all these different types of risk. They're different. It seems different because it's new. They don't necessarily understand it. A lot of the the protocols are new and have different concepts than what people are used to. But I think ultimately it really boils down to traditional credit risk, right? I'm sending money through through an app or through a some sort of transactional service to a place, and I expect to get it back. I expect it to be there when I look for it or want to send it somewhere else in a week's time or a month's time. So ultimately, that is the first thing that I would explain to people is that, if you're depositing coins on a platform, it doesn't matter whether it's an exchange, an OTC, or even a custody wallet, make sure that you understand who that entity is, how they are securing your assets, and ensure that you become comfortable to the extent possible that this is a trustworthy platform and you will get your money or your coins back when you want them back. And I think that is the thing that is the most important. Obviously, the other key factor is to make sure that everyone needs to understand the irreversibility of any transactions in the crypto space. You have an address, you send coins to an address, it has to be the right address, right? The settlement risk really comes down to you ensuring that you're not being tricked into sending assets to a place other than where you intend to send them, right? So those two things, to me, are the most important factors that everyone has to be aware of. I think, the market risk and the volatility risk that people talk about in crypto is highly overstated, right? Volatility is a concern, but if you've already, tripled your money or quadrupled your asset base and then lose 10, 15% in a day rather than, moving 0.5% like stock market, you're probably not going to be that concerned, right? So make sure your assets are going where they should be going, and make sure you're dealing with a reputable counterparty. Those are the two most important things.
Nej, you'd been with a family office in the past. How are family offices looking at virtual assets?
Well, there's actually, you can divide them up into two different classes, right? There's the classes that provide services to multiple different families, right? These are more, advanced wealth management platforms. And within this class, you're seeing some tepid kind of approach towards crypto. Some may or may not have invested in crypto funds. They might be exploring crypto ETFs, exchange traded notes, anything of that kind that they can access through traditional markets. But it's very small in terms of their exposure and in terms of their ability to kind of get into it. Then there's the other types of family offices that are actually actively starting to spin out separate business lines, part of the family or part of a group of families, and actually, focus on crypto VC and go into it very aggressively. And they're deploying a lot of capital. Sometimes it's their second generation, third generation that's actively already been trading it for the past 2 or 3 years. Realized returns, and the family's even more convinced that there is, huge profitability that can be made from these. So that's basically the bifurcation in what you have there.
Gerry, what are some of the trading strategies you're looking at these days?
Right now, we're looking at all sorts of opportunities to profit from, an increase in volatility, right? We like the sort of convexity element of digital assets. So anytime that we can, have a portfolio, we look at factor models to look at portfolios of digital assets to try and sort of be market neutral-ish under normal circumstances, but still benefit when they are these sort of explosions or these parabolic returns that sometimes take place. We look at traditional basis trading, which just looks at futures versus spot arbitrage. We look at funding across all the different instruments and look for opportunities to make excess returns. Now across most trading venues, there's sort of an entire futures curve that extends out almost a year and a half from perpetuals, which are rolling every hour, to every 8 hours, to weekly, to monthly, to quarterlies. So we trade across all of those instruments, as well as looking at different platforms and different instruments, right? So it's a combination of all sorts of opportunities that can give us that asymmetry that we're looking for in terms of the underlying returns.
In an earlier workshop, we talked about tokenization and, say, the issuance of security tokens or STOs. How do you evaluate these tokenization projects as they come to market?
I think it's a great question. And I think to a large extent, the fact that we have sort of a lot of traditional asset experience within the DNA of the group, and certainly within the trading desk, helps for us to evaluate, what are effectively securities, right? From the very much on a similar venue or similar type of asset compared to what they were in traditional assets. So the analysis, I think, goes back to first principles in all cases, right? We want to understand what is behind these securities, if they are cash flows or if there is, true inherent value, whether it's from, specific projects or intellectual property. That's the starting point. What is behind the project? What are we likely to get back? What is the timeline? What is the expectation? So it doesn't really pose any new challenges. The only, I would say, the one sort of technical issue is, how do the regulators treat them? Are they in sort of the unregulated space of OTC transactions in Ethereum and BTC, or is it a security that you can only transact on a regulated platform in a regulated fashion? So we tend to spend a bit more time looking at the legality and the compliance aspect of security tokens necessarily than being too intimidated by the fact that they're different from BTC or Ethereum.
As with any other form of investing, there are inherent risks. And with digital assets, some might be higher than traditional asset classes. What are some of the risks institutions should be aware of before buying and trading digital assets?
The main risk, again, is really a credit risk and making sure that you are deploying assets with someone that you can trust, someone who's going to send them back when you need them back, right? I think settlement risk it can be an issue. In many cases, when you're trading digital assets, you may need to actually pre-settle, so send your side of the economic transaction before the individual that you're dealing with sends their economic proceeds. So I think that's quite different, right? There's no London clearinghouse for digital assets, right? To a large extent, whether it's an exchange or an OTC dealer, you're dealing bilaterally with someone that you need to trust, and someone again who there's not really necessarily a settlement vehicle. So you would be sending an irreversible. If you're sending coins to someone, irreversible transfer of assets, not knowing whether the counterparty you're dealing with is going to send them back. So you have to know and trust who you're dealing with. You have to be aware of where your assets are going to be parked while you're trading, whether it's with a custodian or a digital asset service provider, an exchange. So these are things that institutions have to be very well aware of. I think that's always the element that I start with, because I think the other risks are significantly overstated. People talk far too much about volatility in digital assets. Volatility in digital assets is very much a good thing, right? We've seen how asymmetric the volatility and therefore the returns can be on digital assets when you have things moving around as much as they do move around in an environment where you have limited supply. Volatility and increases in volatility tend to be highly correlated with increases in price, which is a good thing.
A few other things investors need to consider when they start investing. Any advice or tips?
The most important thing is to really size their positioning in and how they approach the asset class. Like at the end of the day, you're running a portfolio of your own investments. It's a very personal decision on a professional investor basis. Institutions have to consider obviously the volatility profile of their total investments, right? And you have to size it appropriately. And I believe that's one of the key things. You have to understand that it is a volatile asset class. And based on your liabilities and your liability mismatch, you have to position in a way that you can ride through that, and you have the capital there. You have the ability there to hold it for the next 5 to 10 years, and that's pretty much what you have to focus on, is the next the next 5 to 10 years for this asset class.
There's no opening bell on a digital exchange, and there's no closing bell on a digital exchange. This is 24/7. How do you counsel your institutions you're working at when they're looking at changes at 3 a.m. and how do you sleep as an institutional investor?
It depends on how they're investing, right? And they're choosing a trusted partner like us in order to kind of keep an eye out for those kind of volatility movements that you see in the markets during hours that they're not available. Additional to that is, most of these institutions have locations in multiple geographies. So you have to have that kind of seamless transition between desks in order to manage risk. Lastly, the way I kind of would say is, you have to consider, crypto and I guess smaller kind of altcoins as basically liquid venture capital. And in traditional venture capital, you have lockups of 5 to 10 years, and you're going to have that similar kind of you have to have that similar mindset in order to be comfortable with the asset class. It's going to be volatile. but you're going into it knowing that the potential gains are VC-style gains that you're going to get over the next few years.
Gerry, you mentioned regulated versus unregulated. Can you just help me understand the difference?
I was hoping you wouldn't ask that question because it's a challenge for everyone. If I had it figured out, I mean, you know, all joking aside, I think the difficulty is really that the regulators are not moving as fast as the markets. And obviously, you know, we have an obligation to our clients to try and move as much as we can into the regulated space, but still provide a full service, right? And since so much of crypto is in an unregulated space, that differentiation and dichotomy is important for us to manage. You know, we would love to snap our fingers and have every product and every opportunity be in a regulated sphere so we could, you know, get the proper regulation and offer everything in the right sort of framework. But it's not possible because the regulators are gradually and slowly sort of looking at different aspects of the business and, you know, sanctioning at a what I would say is a relatively slow pace compared to the innovation that's actually taken place in the market. So what we are always trying to do is make sure that we are aware of any, you know, rules and you know, restrictions, and try and offer as much as we can in a regulated sphere, in a regulated framework, but at the same time, in the unregulated space, be able to provide solutions, liquidity, products in a legal way to clients who are interested in transacting, you know, in all of the different innovative opportunities that exist within the digital asset space.
You both profiled a very broad market, fast-moving market. Nej, I'm an institutional investor. Where do I start? What are some of the first things you counsel clients as they're evaluating this?
Well, the first thing you have to do is just speak to the right partners, right? You have to have the right partners in the market to be able to trade and participate in this, right? You know, groups like HashKey, right? You have a lot of them. And the second thing is on, you know, basically on how to invest, right? And depending on your size, depending on your scale, you're going to have to look at things that are, you know, the liquidity profile is suitable for the sizing that you're taking, right? And that gives that obviously your options are fairly, you know, limited in some cases. If you're talking about sovereign wealth funds or pension funds, you're going with the larger coins, you know, Bitcoin, Ethereum, and the larger coins like we discussed earlier. If you're, you know, slightly smaller, you can start looking at, you know, other strategies as well, right? And you know, just fit those strategies and the volatility profile within what your investment mandate is, right? And that's how the discussion has to go through, right?
Fantastic. Well, on behalf of HashKey Group, thank you both for your comments and the insights. And we appreciate the audience for joining us today at Getting Started, Investing in Digital Assets. I'm Walter Jennings, my colleague Nejteh Demirian, and Gerry Ifill. Thank you very much.
Thank you.
Thank you.
Welcome to Get Tokenized, a workshop presented by HashKey Group. My name is Walter Jennings, and I lead communications at HashKey Group, an end-to-end virtual asset financial services group here in Hong Kong with offices in Singapore, Japan, and throughout Asia Pacific. With us today, I'm joined by colleagues Angelina Kwan and Ben EI-Baz, and we're going to be talking about tokenization, a revolutionary opportunity for asset tokenization. Angelina Kwan is Senior Advisor to the Board at HashKey Group and has extensive experience throughout Asia and the US in working in business development, restructuring, regulatory compliance, as well as investor relations. She has previously held senior management positions with the SFC, Hong Kong Exchange, and other multinational companies and financial institutions. Also on the panel is Ben EI-Baz, Head of Ecosystems at HashKey Group. Ben leads the group's strategic partnerships, blockchain applications, and asset tokenization projects. With over 13 years of experience in Silicon Valley, mainland China and Hong Kong. Ben is also an advisor to the Hong Kong Monetary Authority and Bank for International Settlements projects on tokenized financial projects. Today we're going to be deep diving into tokenization and looking at the applications and the uses in industry today and going forward. Before we delve into tokenization itself, we need to first understand what is a token in cryptocurrency terms. So, Angelina, can you give us a briefer on what is considered a token and the different types of tokens that exist in the market today?
Thank you, Walter. Simplistically, a token is a digitized representation of an asset, simplistically. And how did this all come about? In terms of the best examples are Ethereum, which is a token that was created by a young founder by the name of Vitalik Buterin, who came up with the idea of let's build a blockchain. And in order to fund the blockchain, they issued what was called a token to raise funds to build that blockchain. And that blockchain now is used to actually transfer assets, just like a freeway. And that token represents a portion of the funds that would be used to pay for that freeway or that blockchain. So what you have is the advent of what has turned into a digital assets or cryptocurrencies, because what was used for a non-for-profit purpose of building a blockchain and issuing a token for that has now turned into a digital asset that is now being bought and sold, and that token represents value. So simplistically, as I said again, it represents an asset or a part of an asset.
Now, the one you mentioned, Ethereum, to me sounds like a cryptocurrency. Right. What are the other types of tokens? I've heard of security tokens, utility tokens. We don't all need to invent a blockchain in order to issue a token.
No, we don't. And the Ethereum or Ether would be a very good use case and best case example of a utility token, where it is for it was issued to pay for or issued or to fund a utility function or a blockchain. And people may not remember that background, but that was simplistically what it was for, a utility. Then we have something called security tokens, where a share of a company or a specific asset that has been placed into a corporate structure is securitized or actually issued into a security and then tokenized. That token is placed into the security is actually placed into a digital asset or a token, and it can then be sold or traded onwards. And what you would get as a holder of the token is a partial share of whatever that security is. For security tokens, unlike utility tokens, that normally regulators want to actually approve because it touches on what is a corporate structure, as well as looking at what is issuing a security to investors. So regulators do actually want to approve those types of security tokens.
Fantastic. Thank you very much, Angelina. Now, Ben, we've heard mentioned blockchain and Ethereum, but so our viewers can get a clearer picture, where are the tokens created and what other programs or protocols can they operate on?
Yeah, sure. I think Angelina just went over the history of how all this came together. And it's quite interesting, right? Starting from one asset, Bitcoin, and then kind of moving into other assets, right? Ethereum. And I think Ethereum was interesting because it was the first platform that allowed the creation of smart contracts, and that's where a lot of these different tokens have been. That's where a lot of these tokens have come from. And you need a smart contract to deploy a lot more of the complicated use cases of asset tokenization. So when people think about what is it to actually tokenize, what does it mean to actually create a token? Essentially, what you're doing is you are taking a set of business rules. For example, let's say it's a security token. There's certain rules for transferring that token between different parties, right? You can say that people in different jurisdictions, let's say you can only have a certain amount of investors that can trade it, or certain jurisdictions can't trade it. And then what you do is you kind of you code these rules into a smart contract, and then that smart contract the smart contract is just program code. It's just programs, just software code. And then you store that on blockchain. So it's simply simply the activity of just uploading that program to blockchain. And within that program, the smart contracts essentially, it details what's the total supply of the token, any additional rules for interacting with it, and that's pretty much it. In Ethereum, there's a concept of accounts, so you as the account holder can be able to transfer that back and forth and kind of see what your balances are.
Fantastic. Well, now that we have a better idea what a token is, let's move into the crux of today's conversation, asset tokenization. Angelina, what is asset tokenization and why do people consider it a revolutionary technology?
When I first came to Hong Kong, there were people that would actually take carts back and forth, and what they would do, the carts would contain share certificates. They would contain certificates of ownership or bond certificates that were in paper format, and there'd be tons of them, and they'd be moving them back and forth between the security houses. And this was only, 20 years ago.
Oh, wow.
So with asset tokenization today, basically that same type of asset, be it security or a share of ownership, instead of being in a piece of paper or a bond certificate or something like that, you're talking now a tokenized, immutable digital asset, which is actually held on a blockchain, which cannot be changed, that shows your rights, which allows you to get dividends, which allows you to get interest payments if it's coded into the token. And basically, the whole world of people moving things with carts and share certificates, that all goes away because everything has been digitized and coded into a token. And basically, you can trade that token around the world. You can trade it if you can transfer ownership. And at any point in time, you can track who owns that token instead of trying to find the share certificate. You can find out when it's been transferred, when it's been sold, to whom, by whom. And you can definitely check every single part of that share. What was a share certificate is now a token, and you can see who actually issued it. And that whole piece of information, which you can't even see anymore, which used to be in a share certificate, is revolutionary. And I think is going to be the next wave in terms of just putting more and more information in these tokens to allow people to trade them, allow people to transfer assets back and forth. And that's why it is a revolutionary change in terms of how we do financial services and where we're moving to in terms of the entire way the world works.
And I think building on that, right? There's been different waves of digitization, right? The first wave of the cart pushers, and then that's not digitization, right? But there was a wave of digitization came where you could do that on electronic systems. But I think the big difference with blockchain and tokens is the speed of settlement, right? I think in the existing kind of the first wave of digitization, a lot of those records are kept by central clearing parties, central counterparties, and kind of the settlement time for those assets are could be 1 day, 2 days. Whereas with blockchain, it's definitely the advantage is real time settlement.
Just like that. And what's exciting is, for you don't need to have those sheets of paper anymore. You just whip out your cold wallet. It's actually there for you, or it's on your computer system, and all of that information is immediately obtainable.
So with that, let me ask Ben, why would asset owners want to tokenize? Can you name some of the major pain points that these asset owners face that can be addressed by tokenization?
Yeah, no, it's a great question. I think it's probably the most important question that should be asked, right? So if you're going to adopt this new way of this new technological approach, what are the benefits of it versus the costs? And I think there's really three key benefits to doing this. One is the ability to unlock new liquidity. The second is the ability to leverage new ways to de-risk and to diversify. And the third is definitely an efficient reconciliation. So everything we just talked about with real-time settlement. And maybe trying to break that down a little bit step by step from the perspective of an asset owner. So let's say there's many different types of commodities, real estate, and many types of assets that even biological assets that are illiquid, right? And they're illiquid because it's difficult to either track that asset or difficult to transfer the title to that asset. So what happens is that if you use blockchain combined with other technologies, what you can do is you can create a digital representation of that asset, and then it's stored on blockchain. And once there is confidence that there's a connection between the physical and the digital object, then it makes it easy to transfer between buyer and sellers. So in that case, that's where you kind of get the liquidity benefits. The other case, kind of connected to that in the case of de-risking, is imagine an asset owner. So there's a really interesting case study out of Europe where there's an independent asset manager. They've invested in a lot of SME loans through a number of different platforms. And what they've done is they take those SME loans and they put them, similar to kind of securitization, right? They take those SME loans, they put it in a new portfolio, and then they basically create a security token from that, and then they sell off the cash flow rights to those interest payments from the SME loans. So what happens in that case is, because of this structure, it makes it easier for them to structure everything together and allow investors from all over the globe to buy this asset. So from the asset owner's perspective, they get to de-risk because they're not holding all of those loans, and they are able to distribute those interest payments to investors. In the third case, efficient reconciliation, that's really in cases where it's important you have an asset that requires high frequency trading. You don't necessarily want to wait 1 day or 2 days to reconcile ownership of the asset. So you're seeing a lot of that in a lot of these exchange markets and things like that.
Well, we might have jumped ahead a little bit because the next question is about the kind of first and second wave of tokenization. Angelina, can you talk a bit about the first wave and what that encompassed?
Well, the first wave, basically, you saw the financial services companies embrace tokenization first. And what you saw was a wave of fund managers who started tokenizing their products. So one of the first ones, for example, that we were looking at in terms of putting on our exchange once we get our licenses is a tokenized fund. And it would fulfill the license requirements. But what you basically had was a fund that was tokenized into tokens, and it could be sold on our exchange. So instead of getting a statement every month, you'd actually get a token where you could actually take your interest payments, and you could actually trade them on the exchange that they were listed on. And then what you're seeing more of now, but of course that requires regulatory approval, are shares of stock that are tokenized or can be fractionalized downwards. So maybe 1 share can be tokenized to 10 shares, allowing investors to have a possibility of less risk. They could buy a smaller token amount and still get exposure to that specific stock. So that was the first wave of seeing traditional assets move into tokens. And then you're seeing, of course, art. I'm waiting for a Van Gogh to be fractionalized so I can actually have a portion of that. But you're already seeing that with non-fungible tokens of cyberpunk art or whatever it happens to be being tokenized. And gold is being looked at now, as well as other commodities. So that would be the second wave, second wave.
Great. Well, with those traditional assets, that's the first wave. Ben, we've talked about the biologicals. What is the expectation in the second wave, and what should we be looking forward to?
Yeah, I think our perspective on it is, in the first wave of tokenization, it's something that's familiar to a lot of the the financial industry, right? There's familiar concepts, securitization, familiar asset types. And I think as we look ahead, what's really interesting to us is what are the possibilities in the next wave of this technology. And I think the way that we're looking at it is it's not necessarily a next wave that's only relying on blockchain technology. It's relying on a convergence of multiple technologies. So for example, blockchain plus IoT. And IoT is just kind of all these sensors, and there's different ways that you can get environmental data and then somehow store that somewhere. So some of the types of use cases and scenarios that we've been involved in include what I just mentioned around beef cattle, kind of these agribusiness, digital transformation cases where it's different from kind of the previous wave of digital transformation, where the previous wave of digital transformation and industrial internet is all about how do you optimize production and how do you reduce costs, where kind of this next wave is you're actually combining the financial element into it. So once you're able to digitally transform the business, you have this IoT data, by storing it on blockchain rather than a traditional database, you allow financial institutions to potentially trust that data more. and be more willing to, to contribute financial services into that business. So getting to the point a little bit, so outside of the beef cattle cases, we've seen cases of a lot of stuff actually happening in renewables and sustainability and everything in the ESG space. So one project that HashKey is involved in is the Bank for International Settlements and Hong Kong Monetary Authority's Project Genesis, where essentially this is a project in Hong Kong for the tokenization of green bonds, for green finance. And if you look at kind of the institutional investors' perspective on green finance right now, I think BlackRock had a survey in 2020 that stated that somewhere between 50 or 60% of institutional investors feel that a lack of data quality is the biggest barrier to investing into ESG assets. So what that means is for example, if you put your money into something that is purporting to invest in sustainability projects, how do you actually have confidence that the environmental impact is actually happening? One way to do that, in the context of Project Genesis, which I just mentioned, is that you could actually you can put sensors in the field, right? So if it's let's say it's a solar plant that's generating electricity using renewables, well, you can do something simple like putting hardware devices or current sensors in the in the energy generation flow to actually be able to in real time monitor how much energy is being created, and then you store that on blockchain, and then the holders of the asset, whether it's a bond or some other type of financial asset, they can kind of get real time access to information about that. There's also, I think, in the second wave, right, or the second wave 2.0, I think we're seeing a lot of interest from asset owners and people in the industry in trying to connect a lot of these data events to automatically trigger different payments in some of these assets, right? So imagine, for example, a bond that pays X amount if a certain amount of environmental impact is generated, or it pays a different amount if it's below a certain threshold, right? So there's a lot of interesting stuff in there. There's some interesting things that we've seen, in the EV charging space, and a lot of interesting stuff in the second wave.
And what you're also seeing too is, for example, the carbon offsets. So you're an airline company or an institutional investor, and you want to carbon offset your airplanes. So that's a big area that's going to be of growth, and you're going to see more and more investors going into those areas, so
yeah,
that
especially
they can get their ESG.
And the carbon offsets and carbon credits, I mean, the key thing about that, going back to the point we had earlier, like liquidity, right? So if you own this asset, right, if you own this tokenized asset and it represents some type of environmental contribution that you've had, well, kind of in the base case, you have to go to these, kind of these paper-based exchanges and kind of, interact and transact that way. Whereas, in a case where the carbon offsets or the carbon credits are issued or interoperable on some type of public blockchain or something that's a little bit more liquidity, the ability to trade that with different counterparties is definitely enhanced.
Let's talk a moment about creating the token, and who are the parties involved, and where do you even begin? What's the process of issuing an asset-backed security token? Ben?
Yeah, no, it's a great question, right? There's all this hope and promise. How do we actually get it done, right? Practically speaking. And I think the way we look at it is very, very simple, right? It's a very simple workflow. I think the first step is definitely, the business has to be clear. What's the business plan? Why are you doing this? What are the benefits? And how does it benefit the underlying business? So kind of having a clear understanding of the business plan is definitely step number one. Step number two is, you work together with a subject matter expert, someone like HashKey, to work on kind of the structuring and design of the underlying token. So, structuring is all about, which is the entity that's issuing it, and what rights does it give to the holder, who is the right law firm to work with. I think from HashKey's perspective, we've built a strong ecosystem of different partners that can support issuers in some of these cases. So that's definitely the second step, kind of the structuring and design of the underlying token. The third step is the actual digitization process. So digitization is, it sounds complicated, but it's quite simple, right? It's as simple as an issuer logging into an account on a website, and then just inputting the details of the offering, right? So in this case, the offering could be, what are the total amount of tokens that you want to issue? How much are you raising? Are there any restrictions on, investors from different jurisdictions? And then, you have all these fields in the web page that you enter. You press OK, you submit it. And then what happens on the other end is that investors who would like to subscribe to this, they also have an account that they can log into and subscribe, and is the DBP part of the process, right? So that's kind of the third step. And then the kind of the fourth step is the distribution of the token. So actually, after the subscription process is complete, the investors need a place to actually custody and hold those tokens. So there's different platforms you can use for that. HashKey has elements on that side. And the last step is really the secondary market trading. So in the case where the token has been issued and it's been approved to list on a particular secondary market, that's when the holders of the token can really kind of benefit from that liquidity.
And that's where HashKey would be really as an advisor and helping facilitate this whole process and actually helping the issuer come up with a plan. And we'd probably be doing all the token inputting and stuff like that for the issuer and then helping them follow up.
I think a key, maybe just adding on top of that, one key is definitely I think the partnerships in the ecosystem is very, very critical, right? It's not just one company, HashKey just kind of going off and doing everything for issuers. I think from an issuer's perspective, is like you really have to find the right counterparty that can bring in the right partners to make these happen, because it is a new field and you need experts from different specific areas to really bring it to market.
I mean, Ben brought up a very important point. In terms of the tokenization process, you definitely want people that are going to hold your token and enjoy the investment process of it and hopefully reap the benefits in terms of whatever the interest payments or dividends or token price appreciation is. And that's where a good advisor will actually be helping to identify people that would hold these tokens and the right customers that they should be going to.
Well, thank you both for your insights, and thank you to our audience for joining the workshop Get Tokenized, the revolutionary opportunity of asset tokenization. We have a white paper available on tokenization at our website, hashkey.com, and we hope you enjoyed today's workshop, and we hope to see you on our site. Download the paper and join us for future workshops. Thank you very much.
Thank you.